Well, good morning everybody. My name is Malcolm Webb. I'm the Chief Executive of Oil and Gas UK, and it's my pleasure to welcome you to the launch of the 2012 Economic Report. That's the report we produce each year to give a statistical overview of our industry and some commentary on it too as well. And I hope you'll agree with me that this is an industry that the UK can be very proud of and actually relieved to have at this time too. Here is an industry that's continuing to invest in the UK. We are the UK's largest industrial investor, and there's lots more of that to come from this industry. It's an industry that is creating jobs. It is an industry that is paying a lot of tax, and it's also an industry that is protecting the balance of trade to the tune of £40 billion a year. So a great industry, and we're going to tell you some more about that right now. I'm going to hand over shortly to Mike Tolan, my colleague at Oil and Gas UK and the author really of this report, who's going to take you through some of the main messages in it. Whilst Mike is talking, if you've got questions, please submit them through the electronic channels to us. What we don't want to do is at the end of his talk have a sort of pregnant pause whilst we wait for the questions to come in. So if you could submit those questions, any questions as they occur to you, please do so. Mike's talk will last for about 20 minutes or so, and then we'll take those questions online. Many thanks. Right, without further ado, I'll now hand over to Mike to give us his report.
Malcolm, thank you very much indeed for your kind words. My name is Mike Tolan, and what I'd like to do is to give you a brief overview of what's going on in our industry at the minute, based on the work that I and my colleagues have put together for this year's Economic Report. The Economic Report looks not just at the activities of our industry, but also gives a broader insight into our contribution to the economy and our thoughts, not least, on energy policy and our broader remit within the UK as a whole. I'd like to focus on three main themes. Firstly, what's going on and what's currently going on in these last few years. What does the opportunity set look like going ahead? And also, what are the things that we need to land and secure to make sure that the future is as successful as possible, not least for the industry, but also clearly for the UK as a whole. As Malcolm mentioned, we are and remain a very major investor in the UK economy. Last year, we think that capital investment rose further, and we see it actually, as a whole, we invested something like £11 billion in new investment and new production across the UKCS. We also see costs continuing to go up in our industry. But this is not just driven by oil price, not least, for instance, in 2008, when we saw very similar oil prices, we saw investment continuing to decline as it had done since 2006. And indeed, the interplay between oil price, tax regime, and our perceptions of the future of this industry in the UK have a real big theme to play on our activity at the minute. One of the good news things, though, is that we are seeing a lot of investment at the minute driven by success, both in recent discoveries and the technology which allows us to secure redeveloping things which, in some cases, are already many years old. And the big theme for investment at the minute is driven by some very large developments across the North Sea, both West of Shetlands and certainly in the central and the northern North Sea. And these cover things such as the Schiehallion development and the Loyal development West of Shetlands, Golden Eagle, all those were developments introduced in the last year or so. When you look back, though, as I mentioned, 2008, a time of similarly high oil prices, we'd seen activity dropping and dropping further. And it led at that time to intervention both by the Chance and the Prime Minister of the day, who met the industry and set us a challenge to know what to do with government to change the regime that we invest in to make sure that we were as active as possible in the North Sea to deliver as much as we possibly could back to the economy, both in production and frankly also new revenue to the Exchequer. And that led to a range of initiatives which have, by those interventions, I think, helped to promote investment here in the UK. The positive sign then is that that surge on investment is being felt across the whole economy. And as you see now, we know of thousands of companies that are actively involved in supplying our industry. Our association already has something like 250 members representing every facet of the supply chain here in the UK. And many, many companies beyond that, we reckon into the thousands, actively involved in providing across the UK into our activities. And those themselves employ many thousands of people in activity both to sustain and support our current production, as well as to deliver new production to the North Sea. And one of the key themes about strong investment is that it continues to sustain existing jobs and also drive new employment. It's important, not least, that per every £1 billion we invest a year, and we invest a lot of those a year, we see something between 10 and 15,000 new jobs created or existing jobs sustained across the economy. So strong investment leading to strong employment, benefiting the economy as a whole. So it's easy just to think this is a simple story of new investment giving new good stories for activity, but every pound that goes in has to be converted to new oil and gas production. And what we've seen is that capital efficiency, the bang for our buck, has declined over the years. Certainly in 2010 and 11, it's probably a third of what it was a decade ago. So it takes a lot more money both to produce and to indeed develop new oil and gas here in the UK. A theme across the industry as a whole, but one which is really standing out in the UK. We have, though, seen that production, whilst production has declined, that production is delivering new opportunities to us here in the UK. And certainly at a time when our economy is under some great duress, our production's led to us saving imports for energy worth something like £40 billion last year. So we remain an active part, an active stay in the UK economy, and very much can do for years to come. The issue is not just, though, that we need to keep doing the current business, we need to keep developing new fields and finding new opportunities for us here in the UK. What we see is production continuing to decline, and even now, if we just look at the current investment, which is something like £30 billion locked in already in the economy this year, then we will see production halve yet again over this next decade. And we need to keep sustaining and bringing on new developments to create new opportunities and to keep our infrastructure open and to prolong the life of the North Sea. As you see in this slide, there are plenty of opportunities out there. They do range in their attractiveness, and the challenge is to make them attractive enough to develop in what is already a very demanding environment. Many of our opportunities, many of our infrastructure is now something like 40 or even more years old. So this is not a spring chicken. This is really quite a difficult development scene to work in. One of the things you do see is that despite everything, we still have an awful lot of opportunities ahead of us. And if you look back, say, 5 or 6 years through 2005, when we stood then and looked forward, we had something like 12 billion barrels of oil and gas, either in development or potentially able to be developed here in the North Sea. The good news is, even in 2012, when you look ahead in people's plans, we have a similar volume of oil and gas up for development or potentially already being connected and in production. The challenge, though, in 2005, we had a much stronger production base. So if you like, we had an awful lot more fields connected and a much stronger production base to build on. What we see now is production is lower. We have a great deal more opportunities potentially coming in, but we need to find a way to attract them and make sure they come on stream on time and fast enough to keep the existing infrastructure open and functioning. So it really is a race to keep the industry busy and to make sure that we keep the infrastructure full enough to sustain for long-term operations. So if you like, that race against time needs to be fed by new exploration and new production activity. The key to us, at the first place, is always to explore and find new opportunities. We've seen many recent successes, but most of those, unfortunately, have been in Norway rather than in the UK. And the challenge for us is to sustain a high rate of opportunity so that we can make a high rate of exploration activity so we can make sure we make the most of the North Sea. If you look in DEC's website, you will see that we have something between 3 and 9, maybe billion barrels of exploration opportunity that are identifiable across the UKCS. And if we look at the more challenging things, that 9 could easily be as high as 16 billion barrels still to be explored for across the UK. So that's a great opportunity set. The challenge is, are we going at exploration hard enough and fast enough to be able to deliver on that opportunity? When we look back to 2007 and 8 and 9, what we saw was exploration strong and growing, driven by higher oil prices. When we look now at 2011, we see exploration a fraction of what it was in those years. And the challenge now is to see how we get exploration back high enough and strong enough to realise the full potential of the UK. Indeed, last year we saw exploration halve compared with the year before, and the year before was by no means a good year. What was then driving exploration down? Part of it was obviously still a bit of a hangover from the financial troubles of recent times. Exploration is driven by the need for new finance, and without that finance it is harder to explore the North Sea. It's also driven by the fact that a lot of the resources we need to explore are in strong demand. But it wasn't made any easier by the fiscal instability we've seen in recent years. And with stability, we get much better focus on driving the day job and exploring the opportunities. The challenge for us then is, how will 2012 be as a year? Will it be back to the levels we more hope to see, or will it again be rather like 2011? When we look, in 2011, as I say, exploration fell and was indeed the lowest we've seen for more than 2 decades. In 2012, we think exploration will be higher, but we're by no means confident that it will be as good as we see or even forecast only a few months ago. So the jury's still open, a lot of attention on this. I know we're engaged closely with DEC and with Treasury on exploration activity and how this will deliver new potential and ultimately new reserves and new income, both for the industry and also for the Treasury. So one challenge is exploration. Another challenge for us is actually delivering near-term production. We have a strong investment base and a lot of new barrels coming on stream in due course. Indeed, last year, our investments led to 1.7 billion barrels of new developments being initiated, and those will come on over time. But the challenge is, when you look back over the last few years, production has fallen, typically between 6 and 8% a year, but last year was an exceptionally bad year for production. And that challenge remains with us as we look into 2012 as well. And indeed, when we look at the first quarter of 2012, still reflected a downward trend. So there's a lot to do still to shore up the production base and make sure that we're strong for the future as an industry and able and ready to take the new investment and the new opportunities that we face ahead of us. Certainly one of the big drivers that slowed down production in the last few years is the slowdown in investment. And what we don't want to see again is that slowdown, so that, for instance, in 2008 and 2009, the very small investments then meant that we only had small amounts of production coming on stream last year. And this is a relentless industry. We need to keep investing to deliver new production, and only by doing that can we actually shore up and deliver the income, the opportunity, and frankly, the wealth that the country needs these days. So on the positive side, we have still a great deal of opportunity left in the North Sea. When you look from our point of view, we see something like 15 to 20 billion barrels of new oil and gas still to be developed. And indeed, if you look and you see all the opportunities ahead of us, it could even be higher. But none of these can be won easily. When it comes to both ensuring that the existing fields can produce their maximum, currently that means making sure the integrity, the long-term maintenance, and the infrastructure is up to a very demanding and very long journey ahead of it. We need to do more to make sure that brownfields, those fields which are in production, can actually maximise their potential, and also look at those undeveloped opportunities still in the UK, accelerate them and bring them into production as fast as possible. The success in doing so is an enormous one for the industry. When we look, there is something like £1 trillion worth of opportunities in the North Sea still to be developed, still to be brought in production. This is a massive prize, and it will take decades to deliver. Each one of those steps is an important one for us, and sustaining investment and ensuring that the current infrastructure is up to that long-term journey is essential. Like all these things, we engage closely with our partners in this business. The government, through the tax regime, through the regulatory regime, is an active shareholder in our industry. We can only achieve our success together. We cannot do it on our own. And one of the key things to helping us achieve this future is, frankly, for both sides to live by their business commitments and deliver those things which can make this industry strong here in the UK. And whilst we have had undoubtedly a demanding relationship with the Treasury in recent years, it was good to see that in Budget 2012 they recognised the strong benefit this industry can deliver to the UK economy. In 2012, they reaffirmed their commitment there to deliver on 3 key areas which are all hard-nosed business decisions as much for government as it is for industry. Firstly, to ensure that we can be clear about the long term, about decommissioning, so we can be clear both about the regulatory and importantly around the fiscal regime when it comes to decommissioning, so we can plan properly and be confident that when you get there, you know what will happen. That certainty enables companies to take away those doubts and risks and questions about the long term and focus on the near-term activities which can keep this industry successful as it is for as long as can be. We're also working very closely with government on trying to maximise the production in some very mature fields. The industry calls them brownfield opportunities, trying to make the most of existing fields, many of which have been in production for 30 or more years. And by working on those brownfield opportunities, we see those a great opportunity to deliver new investments in some very difficult opportunities and creating some new opportunities beyond that as investment leads to production and leads to tax and revenues for the Exchequer. We also are pleased to say we're looking continuously to make sure that many of the most marginal opportunities, not least in the southern North Sea, where gas prices are half of oil prices we're seeing currently, are actually monetised, attractive and able to be developed as fast as possible. So working together with government, we believe we can sustain investment and keep this industry active for many years to come. But it is a close and demanding relationship to make sure we deliver the best. We also are working very closely with DEC on a whole range of issues that are technology and skills driven. The UK is a leader in oil and gas across the world. It's true to say that we're good at pharmaceuticals, it's true to say that we are good at financial services, we're very good at automotive. And one of the key opportunities that both DEC and BIS, and I'm pleased to say other offices of government have recognised, is our great competency as an oil and gas province, and frankly as an oil and gas economy. We are very good at the skills, the technology, and the capabilities that lead us to be a world-class industry. So working with DEC, we're looking not just at increasing the oil and gas recovery, we're also working with DEC on those enhanced oil technologies that we need to really make the most of the long-term future of this industry. Technologies which are still very demanding even at current prices, and can only really be brought in by really close liaison both with DEC, and with Treasury and with BIS to make this a successful long-term for the economy. We're also very keen to work with the government to make sure that we retain the focus clearly on safety, and that focus is a UK rather than an EU-driven task. We are best at managing our own affairs, and we're really good at focusing on safety and long-term integrity of this business. So, the UK in 2012, it is a challenging province. I dare to say it's actually too often ignored by many people who are not close to the North Sea. And one of our strong aspirations is that when key officers in government stand up, they pronounce how good we are at oil and gas and energy engineering, as much as we are, yes, at pharmaceuticals and even financial services. That recognises the £1 trillion prize still to be secured here in the North Sea. If we get that right, we can provide the UK with energy security, strong value, employment and skills for years to come. Indeed, if you look on DEC's website, their figures, not ours, you see that in 2020 we could still be producing half of the oil and gas we need still in the UK from UK resources. That for an industry which by then will be producing oil and gas for more than 50 years will be a great success, and is one we want to continue to work in. So for us, a huge prize remains, and the challenge now is to see how we convert that to long-term opportunities, new skills and new jobs here in the British economy. So Malcolm, that's my presentation and my thoughts. As I say, I know you will be able to receive the report via the webcast. And Malcolm, perhaps over to you now for any questions that might come from the internet.
Oh, great. Thanks very much indeed, Mike. I'll say it again, I think it's a great story, but there are challenges out there as well, and no doubt we'll touch on some of those in the questions as they come through. And thank you, everybody. The questions are flowing through, and we'll kick straight off. Right. You're talking about a lot of extra investment this year. How many jobs does that equate to in the UK and in Scotland? And I think there's a linked question as well from somebody else. Actually, what training needs does the industry have in coming years? Is there a skills gap, and how can it be plugged? So what does this mean in terms of jobs, and do we have any skills gaps?
Well,
Mike, do you want to start off?
Yeah, well, thank you, Malcolm. Employment is a key activity for our industry, And I certainly, if you look in the headlines across the UK, you see that many, many jobs are both sustained and created. Many, many big employers have announced growth and further increase in jobs here in the UK. Across many of the big engineering companies, they're very actively recruiting, both at colleges and universities, but I'm pleased to say across the age spectrum, not just young, but the mature engineer is in really strong demand. When you look across employment as a whole, we believe something like 440,000 jobs are both sustained and provided by our industry here in the UK, both in direct activity, indirect activity, and broadly across the industry as a whole. Certainly also, as I say, every pound invested delivers new jobs and new opportunities here in the UK. And we say something like 10 to 15,000 jobs are sustained and provided for each £1 billion we spend. So that gives you an idea of the scale of this industry.
So that's a significant issue, isn't it? We're not talking in hundreds of jobs here, we're talking in tens of thousands of jobs.
Very much. And you see from many, many of the headlines many companies make, 1,000 here, 100 there. These add up to big numbers when you look across the UK economy. Your question also raised skills, and skills as an agenda is one we strongly support as an industry and are very actively engaged on. We recognise more than ever that we need to grow UK talent to be able to fill these jobs and opportunities both now here and in the future. That is an activity spread across the UK with roughly 50% north of the border and 50% south of the border across Britain.
Yeah,
Malcolm.
Maybe I come in there again on that skills gap issue. We're going to be holding a skills summit later this year in September, when we'll be going into this in some detail and putting in place, we hope, some concrete plans to help on that. But I think if we see an issue at the moment, it's not so much with graduate attraction or new entrant attraction into the industry. It's more the experienced hand, actually. It's the skilled workforce, and that's where the demand is really. And maybe we need to be looking more at what we can do on sort of what we call cross-training, bringing people in from maybe other parts of the economy that aren't prospering quite as well as oil and gas at the moment, and training them in the appropriate skills for our industry, taking their basic training and converting it to help us. I think that's an area we definitely need to look at. Next question. What does the fall in oil prices this year mean for the UKCS? And secondly, are you aware of any companies revising their investment plans in the light of the price fall?
It's a very interesting question, Malcolm, and certainly we have been watching what the oil price is doing. If it remains at current levels, it would be anything but wrong to say that these are prices which make the UKCS competitive. The question is the long-term direction of oil price, and we as an industry are used to big swings and changes in oil price. The challenge comes when you have those big swings and changes maxed by big swings and changes in the tax regime. And so at least let's focus on the oil price and have a steady tax regime to work from. That's crucial in the first place. But certainly, if oil prices were to fall below the mid-80s oil price, mid-80s dollars a barrel, we'd be a lot less comfortable in industry to be able to invest in here in the UK. And so we work from that premise. I'd certainly note also that gas prices still remain quite a challenge in the UK compared with oil prices, and make many investments much more difficult to play in. For the long term, I think people, if we're seeing oil prices remaining in the current sort of trajectory, are prices which are right for the UK to be able to invest offshore. This is a very competitive and very demanding industry, and one which is expensive to do here in the UK compared with many other parts of the world. Malcolm.
So you haven't seen any companies revising their investment plans on the current price scenario, right?
No, I think where we are now, people recognise the opportunities and want to get on with the day job.
Okay. Right, next question. Exploration success in Norway has been driven by new reservoir models and target horizons. Any indication that such new thinking has migrated across the median line into the UK sector? Do you want to lead on that one? I think it's a very good question, and I think there's an awareness abroad that we need to think about the way that we're going about exploration maybe in a new way, and take on the new technology. Subsurface imaging is hugely improved these days. New seismic techniques and the like are enabling us to go for more subtle plays. And I think it's a very good question, and I think it's something that the UK has got to make sure that it's right at the forefront on. I'm hearing lots of people in the industry saying that the new developments in subsurface imaging are very exciting, and they can help us to de-risk the exploration play. So I think this is an important area for us to invest in. You were talking about technology earlier, Mike, and I guess this was one of the areas that you were thinking of. Yeah?
No, very much. I think that, you know, clearly many of the companies that are active in Norway are very much also active here in the UK. And no doubt they will be looking as hard in the UK for those opportunities as they are in the UK. And in many cases, they're brought by new insights of applying those technologies and themes for exploration plays. I'm sure, for instance, we exported a trick or two, for instance, when buzzard was discovered back in the early 2000s by our thoughts then on stratigraphic plays, exporting those not just across the UK, but also to Norway. So there is an interchange and exchange of ideas, and I hope that will actually benefit us here in the UK. There's at least one elephant out there, but I don't know where it is.
Right, thanks. Next question, and thanks for all the questions, by the way. Keep them coming. Mike said that production was exceptionally bad last year. Why did that happen despite record prices? So let's have a bit more explanation about that fall in production last year. And it was pretty heady, wasn't it? 19%.
Yeah, so thanks, Malcolm. I think there were probably two strong themes to this. First of all, we weren't and we haven't been bringing new developments on fast enough. It's a very cruel industry, this. You have to keep converting new money into new opportunities, into new production to sustain your production base. Without that, production falls rapidly. So we need to keep bringing new things on. And whilst there were, I think, 5 or 6 fields that came on in 2011, they were only very small, and together they amounted to something like 30 million barrels of new production. So only small stuff came on, which meant the foundations weren't what they should be. On top of that, I'd certainly say that many companies were held back then as they looked afresh at the integrity and the maintenance of their fields. They recognise more than ever that the industry has a long-term future in the UK, and a lot of stuff was taken offline and a lot of maintenance was done to bring it up to that long-term capability rather than just a short-term horizon. It sees a strong commitment from government and industry to deliver the long term. It's been focusing on that. Things that have remained difficult, many of these fields are very mature, and maintenance, unscheduled maintenance, cracked in and also into a lot of things, had a downtime that they didn't anticipate, and they're still working to address.
So it was a whole range of things, wasn't it? There isn't, I don't think we can point to one particular issue. I think the questioner is right, though, saying sort of counterintuitive, that when you see the oil price doing what it did over the last couple of years, that you see production sliding in that way, and also that you see exploration falling in that way as well. That's another interesting issue too as well. But there were many issues behind this production. Other factors, for example, is that the Rum field, there are political issues in here, that the Rum field is shut in at the moment. That's about 2%, I think, of UK gas supply because of the Iranian the Iranian oil company has got 50% of rum, and it's shut in for that purpose as well. So there's a whole host of reasons, but I think probably the dominant one was the asset integrity issue on some of these fields, linked with the fact that we didn't have many fields coming into production last year, which was a sort of hangover from the last piece of tax turbulence, wasn't it?
And I think it's good to say, Malcolm, that people, whilst clearly price drives focus, no one was willing to take any risks on integrity regardless of the price last year.
Right. Okay. Next question. Does the possibility of constitutional change in Britain's governance in the not-too-distant future pose any threat or perhaps opportunities for the UK oil and gas industry? Well, maybe I'll start on that one. The referendum is coming up in 2014 now? I think that's when it's going to happen. Oil and Gas UK's position on this is quite determined. We are neutral upon this issue. This is a matter that needs to be decided by the electorate of Scotland. It's for the voters to decide. It's not for us to lecture them or encourage them to vote one way or the other. This is a decision for them. As far as our industry is concerned, I would hope that whatever happens, whether we have a continuation of the United Kingdom or we have a new constitutional arrangement, the importance of this industry, as we've outlined today, will be fully understood by whichever government is in power, and that the industry will go on working in open collaborative engagement with that government to make sure that we do maximise the recovery of this hugely precious reserve. And I think that's the stance that we would take upon that. We would expect, because of the importance of it, all governments to understand that and appreciate the importance of working to that end. Mike, anything you would want to add?
No, I think you're right on that, very much so, Malcolm. The key drivers for this industry is long-term certainty and long-term clarity, and we know that both the UK and the Scottish Government are focused on trying to deliver that certainty and stability for the industry. Suddenly we also need to focus on the technical and the operational challenges, and those are as important for the Scottish as they are for the British economy as a whole.
Okay. It appears that relationships with the Treasury have improved as they rectified some of the shocks of 2011. Aberdeen obviously has a major interest in prolonging and growing the sector. What, if any, joint actions can government do to promote, actually the question cuts off there, I guess it says promote increased activity with the industry?
Well, thanks, Malcolm. I mentioned during the presentation, at the end of the day, there was a strong business relationship between this industry and government. And I think one of the good credits that certainly we saw happening both with the last government and indeed with the coalition government is they recognised there was a business to be worked on here, that the industry and government have to keep making decisions which are right for the industry and for society as a whole, both in the tax, but more importantly, in those things around the tax regime which promote investment and drive long-term thinking. And so it's that long-term business decisions which are at the heart of our relationship with the Treasury. The more we work closely on that, a very challenging relationship, the better and the longer term this industry will deliver, not just for Aberdeen, but for the UK as a whole.
Yeah, I wouldn't want to rake over 2011 again. It was a severe and nasty shock, but since then I have to say that we have a new engagement with government, and not just the Treasury. I think it's also important to note we have a strong and constructive engagement with the Treasury, and we're very much hoping that's going to go on and deliver, and it needs to deliver further things this year. But we've got a good engagement as well. And we've had a long one with DEC for a long time, but also with the Biz Department as well. That's very strong and important too, because of their role in skills and technology issues we were talking about before. So we are determined to constructively engage with government. That has to be the way forward, and please no more nasty shocks. Yes. Next question, shall we? You did expect production to rise in 2012, and now you say it will struggle to meet last year's forecast. Can you give any more guidance on how much lower it will be than last year's? How confident are you that production will rise in 2013? Mike, do you want to start on that one?
Gosh, right to the heart that one, and I think it's a darn good question. There were a range of factors, as Malcolm mentioned, which held us back last year. We are seeing a number of new developments coming on stream, and those will help shore up and gradually build up production. And if nothing else, the wave of investment, which was something like £11 billion last year and £8 billion the year before, that sort of rate of investment rapidly starts to bring new production on stream, albeit it seems to be taking longer than we hoped. That will come on stream and that will generate those new revenues. But the key thing still, in the short term, still integrity issues, and I'm afraid the slowdown in production, not least because of Elgin going offline, have meant that the industry is anticipating production to be lower in 2012 than we had hoped for, not just even only a few months ago. But underneath it, the fundamentals are good, and the issue is to make sure we address integrity, ensure that production comes on stream rapidly, and promote new developments as fast as we can.
I think there's no denying, is there, that we're going through a sticky period here. One might call it the sort of post-Macondo sticky period, but we do need to get out of this, frankly. And although we can only see the first 2 months, I think, of field data for this year from DEC, it does look that this year has not started off too well either, and we're seeing further production decline. So we can't ignore this. We've got to work on the issue. I do think, by the way, that's one of the reasons why this brownfield allowance is a very important, necessary addition to our armoury, and we're looking for an early announcement on that. It's something that we can't ignore and that we've got to work on. On the other hand, we know we've got these major projects out there. There are 5 huge projects out there that are going to deliver increased production over time. But we can't just concentrate on that. We must avoid a 2-speed North Sea developing here. We have to make sure that all of the assets are being worked and that we're making investments right across the board. So it's an interesting challenge for us. Well, here's another one. There are ongoing infrastructure access issues. Are these being addressed in the light of the small companies and small developments coming through? Well, maybe I'll start there, and Mike, if you want to add something in, I think the answer is absolutely, definitely. Yes, they are being addressed. I can tell you that within Pilot, we're working very hard there. There's a very active work group looking at the whole issue of the infrastructure, looking at these hubs, trying to assess what these offshore infrastructure hubs, what their life is and how we need to keep them in use, and what can we do to improve access, to try and speed up the whole process of people getting access to those infrastructure hubs and on reasonable terms. That Pilot work group is due to report towards the end of the year. It's very active. It's an issue that the industry and the regulator both take very, very seriously, and it's definitely one that we can't relax on and we need to keep on working on, because as the question implies, if we're going to keep this infrastructure in place, we need to make sure that there's a flow of these smaller fields that we're finding being developed and being plugged into that infrastructure. Otherwise, it'll be taken away, and then some of these reserves will never be produced, and that is not at all the right answer. Mike, is there anything you want to add on infrastructure? Or?
No, I think you brought the main points up there, Malcolm, and it's key that we look for the long term. It's very much obvious when we see, though, that there is lots of infrastructure out there able and ready to take the new business. We need to keep bringing the new business on so we can deliver these new opportunities.
Right. Next question. What is the position of Oil and Gas UK with regard to knocking heads together at DEC, Treasury and Energy UK over the capture and use of CO2 for EOR, enhanced oil recovery, in the Norwegian, Danish and UK North Sea? Mike?
A big question, that one. I'd like to avoid knocking anyone's heads together. Our safety behaviours alone would mean that would not be a good thing to do. Certainly this industry recognises it has a part to play in carbon capture and storage, but it's only part of a much bigger business chain if it's going to be successful. Yes, we have the technologies, we have many of the supply resource companies that can best manage the transportation and indeed the activities around storage, but we also need to work very closely with utilities if that is to happen. So it's actually a much more complicated picture than just the offshore frame. It looks also at the business chain from the utility, the power station, all the way through the well itself. And our challenges are not just that complicated business chain, but also, frankly, in the current circumstances, none of the opportunities out there are commercially very attractive to undertake. And the big journey, as many people will know, working with DEC, is to try and put that seed corn funding in to really initiate these new investments and to support them with a price mechanism which allows those long-term activities. So very much still an opportunity in an industry in its infancy, one though we will be part of, I'm sure, for years to come.
Yeah, I agree. Thanks, Mike. I can see the questions are still coming. Please do keep them coming. I can't see the full list, though, but I can see we've got another couple here. So, right, next one. What would the cost to the UK industry of the EU taking over responsibility for offshore health and safety be? Well, maybe I'll start on that one. There would be a cost. There would be a financial cost. Our view is that the Commission's impact assessment that they did on this is seriously flawed, and that the cost of what is being proposed in this offshore safety regulation far outweighs any of its benefits. But that's not really the important point. The important point is that this would be a huge backward step in UK offshore safety. That's the real issue, and that's why we're opposed to it. Cost is a secondary issue on safety. We can't. I'm not trying to say I'm just wiping that away, and it is true. This will bring more cost, and substantially more cost than it brings any benefit. But it's the second part that's really important. Not only will it not bring any added value here, it will actually put us back several steps in the UK. We're going to have to, if this regulation went through, we're going to have to dismantle all of our UK law and regulation on offshore safety, because it would otherwise be seen to be conflicting with this new EU regulation. We're going to have to restate all of the safety cases. There's going to be a huge diversion of regulatory attention and control, and for what? For a one-size-fits-all regime, which frankly we don't think it has the right focus on safety. And that's why we're against it, and that's why I'm very pleased to say the UK government is supporting the industry in this, and of course we have the support of other countries around Europe on it, and their trade unions. And I also think it's very interesting that the Norwegian government has now said it is not going to play. It doesn't see this as having application in Norway, and it's not going to use this regulation. Well, that means, I think, frankly, the legs have been somewhat cut away from underneath it in any event. Okay. Mike, is there anything you wanted to add on that?
I think only on the cost side, the greatest risk actually is a cost to safety, and that's something we don't want to pay under any circumstances.
Yeah. This is a specific question, but I think we can probably answer it. With regard to the rum field, we tend not to usually answer specific company, but with regard to the rum field, do you see that the field remaining offline as long as sanctions against Iran are in effect, or is the government industry considering alternative routes to bring back production? Is expropriation an option? I don't think we're actually qualified to fully answer that, but I'll give an opinion in any event. I do think it is a great shame that we've got that field shut in because of this, and one wonders if there isn't some way that one could deal with this problem through an escrow account, so the operator could keep on producing the field, but the incomes from the gas revenues could be placed somewhere into an escrow account. At least then we wouldn't be damaging the oil and gas, the gas flow to the UK. But maybe I shouldn't have said that. I'm afraid I have to say I'm not up to date on what the precise discussions are there between the government and the field operator there, and that's one really principally for them. Okay, let's go on. On the whole issue of decommissioning liabilities, does Oil and Gas UK have any comment regarding the mass downgrades of European banks below AA credit ratings, meaning that field operators who have used letters of credit from these banks to cover their decommissioned liabilities to guarantee the original, and I can't see the rest of the question, so what problems do we foresee that might have? Mike, do you want to have a comment on that? And I'll come in as well.
Yeah, no, thanks. That's a very good question. It's yet again it's one of the ripples of the broader financial uncertainties that the whole economy faces, and its impact even for us as an industry here in the UK. What we do see is there are many fewer banks now than even 2 or 3 weeks ago which have the appropriate level of credit rating to be actually proper providers of letters of credit when it comes to decommissioning. So on the positive side, it does mean that we aren't going to see everything cut straight away and whatever, but certainly in the longer term, we're going to see that companies have to look further afield to different banks for that level of security. So it means much more attention on a fewer banks further afield to get the right credit rating when it comes to letter of credit. Malcolm?
Yeah, I think it's a very interesting point that's raised there, and it's more than interesting. It's quite an important one, isn't it? Too. And what we can't allow is a technical problem in the banks to spill over and hurt important investments in the North Sea, or give rise to some wholly unwanted and unanticipated and wrong result there. So I think that's an issue we will need to look at. If we run out of banks with set of the appropriate credit ratings, that would be an issue, wouldn't it? I'm not quite sure we're there yet.
No, indeed, there's still some, but I think
we'll have to look at that.
Strong engagement with Treasury on that one, I know, and see happening already.
Right. With that, I'm afraid we've run out of time for the broadcast here. There are some unanswered questions. What I promise we'll do is that we'll answer those questions and we'll put the answers up on the website. But sorry, we've run out of time there. So if you're still watching us, thank you for staying with us. I hope you found that useful. Do remember that a full copy of the report is now on our website. You can see the whole of the economic report there. But if you would like one to have it posted to you, if you would like it in paper copy, then please contact Sally Hatch, the Press and PR Manager at Oil and Gas UK, and she'll be pleased to help on that. You can get it through the website, or her telephone number, can I give that out, Sally, is 020 7802 2404. Okay, thank you very much indeed.
And
cheers, Mike. Bye, everybody.